Before I get started with the detail of our presentation, I just want to tell you a bit of a story. It's about one of the first clients I had when I worked at Deloitte, and he was an excellent businessman. He ran his business to the T. He did the marketing, he did the networking, he converted conversations into sales, and he really did well. He was a wonderful business person. The only problem with him was the fact that he never wore his financial management hat. Okay, now financial management is more of an accountantese terminology, so if I say anything in that language, you're welcome to throw something at me. But at the end of the day, he didn't look at his numbers in detail. He looked at his profit, and that's the only thing he ever looked at, and that's how he judged the success of his business. Now, his downfall was the fact that he liked his toys, and his toys were 4x4s. And whenever there was a new car, a new 4x4, he had to get it. And he ended up having about 4 or 5 4x4s on the book list. Him, his wife, his son, who was his business partner, and just one for just in case type thing. And he basically killed his business purely because of that. He thought he had profits, were wonderful, but at the end of the day, he had a whole bunch of hire purchase agreements which weren't going to the income statement. He couldn't understand that. And that was his downfall at the end of the day. So if you look at the stats, 87% of small business failures are as a result of lack of financial understanding and financial management. So if you look at the fact that 70% of our GDP is from small businesses, you can understand why this is such an important topic for someone like me in the game. Okay, to get started with the numbers. So the first one we're looking at is probably the most basic snapshot of obviously product-based businesses. We're looking at the gross profit ratio. Basically, gross profit is your sales less your cost of sales, which is your purchases and any direct cost related to those products, which gives you your gross profit, and that is a proportion of sales at the end of the day. This is basically the first thing you need to understand in terms of your business. Do you know what your gross profit is? Do you know which of your products make the most gross profit? Are you spending your marketing money in the areas where you're getting the most money, the most value out of it? The next one is net profit ratio. Net profit is obviously dealing with your sales less your cost of sales, giving your gross profit minus all your other expenses. That is your bottom line at the bottom of your profit and loss in MyOb or in QuickBooks. This is where a lot of the confusion comes in with clients that Peter and I deal with, where businesses don't really understand the fact, how can I be showing a profit, but I don't have any money in the bank? And if you go back to Des, my client from the beginning, this was his biggest problem, was because he didn't understand how it all linked together. Okay, now we're getting to the real number crunching in terms of your balance sheet. Okay, we're looking at liquidity. We're looking at how fast can I pay my short-term debts. Okay, now your short-term debts are obviously your payables, your suppliers at the end of the day. So how quickly can I convert the money that my customers owe me and the stock that I have on my floor into cash so that I can pay my debts? Okay, current in accountantese is theoretically 30 days. So on your annual financial statements, current assets and current liabilities are theoretically 30 days. Obviously, we would love for our customers to pay us in a much shorter time period than 30 days. Stock, ideally, it depends on business to business, industry to industry, how long you've actually got on the floor. And as for paying our creditors, we don't want to pay them within 30 days. We want to pay them longer than 30 days. So depending on how fast we're getting our money in, depends how fast we pay our payables at the end of the day. If you're just looking at performance of your business, it might be a good idea to take the cash in the bank out of this equation. So you're just looking at the performance of your core business at the end of the day, not looking at what's in the bank account as a variable. Our receivables, we're looking at efficiency now. So we're looking at how long does it take for our customers to pay us, okay, which we want as short a time frame as possible. So receivables times 365 divided by sales gives us a number of days. This is where it gets really interesting. When Peter and I would do these types of calculations, we often come up with the answers and then ask the questions, and that's when the business owners now, once you start asking the right questions, you get the right answers. Okay, what happened that changed your receivable days so significantly from day 1 to day 31? Okay, and that's when the decisions that you make in your business in terms of giving extended credit terms to, you know, a certain customer at the end of the day, which is a bit of a strategic move long term, might have a significant effect on your business and also have a significant effect on cash flow. So, you know, until you actually understand the impact of what you're doing and the decisions, you're not really making informed decisions at the end of the day. Next efficiency is payable days. So how long does it take us to pay our suppliers? Like we said before, we're looking at current, so we're aiming for things to be around about 30 days, but all depending how long it takes for us to get our money in is a determinant as how quickly we pay our suppliers at the end of the day. Stock days, this is a really important ratio for those product-based businesses. I'd say it's very common for product-based businesses to have a stock list on their floor which has stock which just runs from year to year to year, and they just, you know, it doesn't move. Okay, and it's one thing having it on your stock list, as such, but it's another thing having that product on your floor taking up space where you can rather replace that space with stock that actually moves and generates profits and generates cash flow at the end of the day. Solvency, we're basically trying to establish how do we fund our business at the end of the day. Are we funding it mainly with loans or are we funding it with equity? You know, interest rates are just continuously going up. So you really have to understand how the effect of a highly geared business affects your long term at the end of the day. So what I'm saying with all of these calculations, and there are so many more ratios that I can throw you with, but these are the basic ones in terms of understanding. A lot of the focus towards business owners is the marketing side of it. How do I get more leads? How do I convert those conversations into sales? And, you know, I'm all for marketing. What I'm saying is that in business, before we spend money on marketing, we need to understand where we are, and we need to understand where's the best place to be spending that marketing money. And you can't do that before you know what's happening and before you crunch the numbers in your business. Thank you very much.